Welcome everybody. Um, just a couple of you here so far. We're just going to still continue with the meeting. I wanted to get into the trading itself. Do you both have trading accounts? Can you guys still hear me? You paper trade? Okay, good. There we go. Vincent, you have a paper trading account? Paper. Good. Okay. So let's do some trades this week. Okay. So let's do some paper trades in our accounts this week. So just paper trades. So let's do paper trades. I'm gonna bring up interactive, and we're gonna pick some trades, and we're gonna revisit them next week to see how we did. Okay. Sound good? Hey Henry, how you doing? Just checking, Henry. Do you have a paper trading account? Henry, can you hear me? Henry, can you type in yes if you hear me? Rodrigo, do you have what kind of trading account do you have? Who do you have it with? And Vincent, who do you have your trading account with? Can you folks hear me? You guys hear me okay? Vincent, can you hear me? Rodrigo, Thinkorswim, okay. Is there a delay? So Rodrigo, you have Thinkorswim. Vincent, what do you have? What's your trading? What's your paper trading account? Rodrigo, okay, you got Thinkorswim, good. Vincent and Henry, what trading account do you have? Like, who do you have your paper trading account? Hey Sam, I can hear you. Sorry, my PC was lagging for a couple minutes. No worries. So, Henry, do you have a paper trading account? No, I have a margin TFSA account. Okay. And who's that with, Henry? Who's the account with? Who do you have your trading account with? Questrade. Okay. And Vincent, who do you have your trading account with? Vincent, can you hear me, buddy? Okay. Who do you have your trading account with, Vincent? Who's your paper trading account with? Oh, oh, they are using a phone. Oh. All right. So the reason I asked was I wanted to put some paper trading trades in this week for each of you and see how we do. Okay. So I want each of you to pick one stock, and we'll go through the process of putting that trade in. And then what we'll do, the expensive one, then what we'll do is we'll visit those stocks and see how they do next week. Okay. So everybody, each one of you pick a stock. We'll walk through the process, We'll put the trade in and we'll see how it does, okay? Okay, so who would like to go first? Who has a stock that they would like to put a trade on? And we'll put the trade on. I'll put the trade on and we'll revisit it, okay? And you can do the same on your paper trading account. But we'll put the actual trade in, okay? Practice account. This is just practice. I don't want you to trade real money just yet. Okay, so who has a stock they'd like to trade? You have Air Canada? Okay. What are you doing with Air Canada? Covered call. Okay. So so let's put a covered call on Air Canada. Okay. Is that the one you want us to walk through? Is there a different one you want to walk through? You have an expiration this Friday. Okay. Do you want to put another covered call on? Do you want to walk through that one together? I'm not sure what will happen with the covered call when it does not strike the price. Okay, well, if it doesn't strike the price, the option will expire worthless. And whatever the stock moved, did it move up or down? What did it do? What price did you get it at? Okay, you bought it at 16. It's trading at 18, right? 18.20, is that right? Covered the call at 19 for this Friday. Yes. Okay. Uh, well, you're going to be in good shape if it stays where it's at. I mean, you made $2 on the stock, and what did you get for the option? How much did you sell the option for? You forgot? Okay. All right. Well, you'll get the option premium plus whatever the stock move is, which if it stays where it's at, you'll make over $2 on the stock. Plus, if it's at 19, and hopefully it goes right to 19. If it goes right to 19, you make another dollar plus the premium. So that's pretty good. It's a good trade. Turned out all right. Um, is there one you want to look at? Any of you can pick a stock. I don't. It doesn't matter who it is. Just let's pick a stock and we'll walk through and we'll put the trade on. Hi Sam, I have the interactive paper account. Didn't touch it for 2 months. I couldn't get in again. Is it policy? I don't think so. You should be able to. I'm not sure why it did that. Maybe reset the password. I don't know. Is it locked you out, Vincent? The account? What does it say? Rodrigo, okay, we'll do Coca-Cola and Henry. Do you mean, oh, the premium was 225? That's excellent. So you're gonna make like, on one contract, you're gonna make, 450 on it. That's great. That's a good trade. Hopefully it'll strike at 19. Yeah, if it doesn't even, you're going to do okay. As long as it's, if it stays where it's at, you're still going to do well. If it goes to 19, you'll make over 500 on that trade, looks like, which is pretty good. I can't remember Coke's. What's Coke's symbol? Rodrigo, what's Coke's symbol? Sure, I can find it. Right, no, European Partners. KO, there it is. Right there, got it. Okay, so KO, okay, Coca-Cola. Okay, so first thing we'll do is we're going to go to the chart. So let's look at the chart. Okay. So let's go to here. Let's see if that gets us the chart. Okay. Let's look at Coca-Cola. All right. So this is Coke. Okay. So we had a double top there, and came down. It's in the lower range there, and then it popped up. And it looks like it's going to get some resistance here. Okay. So you're at the top of the range with Coca-Cola. It is, in the short term here. This is a daily chart, right? So it's in the short term here. In the last couple weeks, it's been trending up. This is what we call a hangman. Usually, it's a negative thing for the stock. But if you want to try it, you can. You're at the top of the range. You see that, Rodrigo? You're at the top of the range. Of this range here, this sideways kind of motion, you're in the range and you're in the top of it. So you might see some resistance here. So it might pull back. If I was looking at this, I might, we can look at it, it's sideways, at the top of the range, but there is room. It could go right up to this. It could go up to $50 from there. We can try it. Okay, you would like to try this one? Is that right, Rodrigo? You want to put a trade on for this one? Okay, so all right. Okay, so for Coca-Cola, first thing we do, okay, is we check the chart. It's not the best chart, but I mean, we can put it. It's in a sideways motion. What's the next step? We look for 30 days out. So over here, too far. Okay. Okay, 30 days out, which is the August 14th expiration. Okay, so we're going to add the stock, 100 shares, and we're looking for the 40 delta for the call. Closest one to 40, which is the 47.5. Everybody see that? 47.5, 47.50 is the 40 delta, closest to 40. So we're going to sell that. Okay, so we sold it. Okay, so we're buying 100 shares at 46, looks like 46, around 46.50. We're selling the 47.50s. It's bringing us $1. If we do that, Rodrigo, over 30 days, we have to calculate what's the return. What's the return? Remember, what's the rule? What are we looking for? How much are we looking for? How much are we looking for a return, monthly return? Yep, at least 2%. So if we divide $1, we divide $1, 03, $1.03, which is the lower end of the range, but just say $1.03 into 46.50. it gives us a 2.2% return, so it qualifies. So we transmit the order. We hit transmit, so it's giving us the order. It's got the 47.50 call plus 100 shares of the stock. So the price that we're putting in is 45.45, right? So they take the price of the stock less the 103. That's what we're paying, 45.45. Okay. So we're going to transmit, and that order will be placed tomorrow. And if it triggers, it triggers. We're done. There, that trade's in. Good. Any questions about that? Yep. We'll see what happens with that one. Rodrigo, you good? See, the market's closed. We don't have to worry. It's not moving. We're trading now, okay? Sam, would you do a cover call without actually buying the stock? You mean, okay, so you mean buying the option and selling the option? You mean without stock? Is that what you mean? Yeah, exactly. I would prefer that. So let's say we did it with this one, okay? With this one, okay? So what we could do is buy closest to 60, which is, and this is only 30 days out, buy closest to 60, which is here, looks like 62. So we buy this option, okay? And then we sell the 40 delta again. We sell that one, okay? So that's two separate. Let's get rid of that for a second. Let's get rid of that. Let's cancel that. Hold on one second. Okay. Okay. So let's do it with a strategy builder. Okay. So we buy closest to 60. Okay, which is there, and we sell the 47.50 there. Okay, so what we've done is we bought for 214. Okay, and that's basically at the money, right, or just above. Sorry, my apologies. It's $1 in the money, and we're bringing in $1.03 for the trade. Okay, so this is called a spread trade. It's actually a debit trade. Debit meaning you have to pay to get in. A credit trade would pay us. Okay, pay us for it. So we did if we believe it's bullish, we could buy the 30 and sell, buy 30 days out, right, closest to 60, and then we could sell this one. Or if you wanted, you could even go further. We could go say 60 days, go 60 days out, 65 days out, get the 60 delta there, okay? So the 60 delta closest to 60, which is this, we'd pay $298. And what this allows us to do is it gives us a couple months instead of 1 month. You see what I mean, Henry? So instead of just 1 month, right? The other thing we could do, any questions about that, anybody? Everybody understand what we just did there? So we bought, instead of buying the stock, and the idea behind that obviously is to use less capital, right? We're going to use less capital. If we go 30 days out, closest to 60, sell the 30 days. But typically, Henry, when you're doing that, you want to buy, 60 to 90 days. 60 to 90 days out. You don't really want to buy 30 and 30, but you could buy 60 to 90 days. The strike price should be the same in that case. You mean when you're buying further out? Is that what you mean? Buying further out? Right now, buy the strike 45.50, and you sell, yeah, the 47.50. Yeah, that's right. So it's not the same strike. It's not the same strike. So why don't we do this? Why don't we put this trade on too, and we'll see which Should it matter if it's the same strike? Yeah, you don't want the same strike. The only time you'd have, it's a different strategy, but it's diagonal. It's a diagonal trade. I don't want to get into that right now. That's a more complicated trade. But this trade is buying the option, selling the option, right? They need to be different strikes. Does that make sense? Okay, because it's the same month, right? So let's transmit this one, folks. So this one's going to cost us $1.01, okay? And the idea behind this is we believe the stock's going to go up, and if it goes up, we make money. Obviously, if it goes up, and if it goes down, we can only lose $1.01. Does everybody see that? You can only lose $1.01. If it stays exactly where it is, will we make money? Well, we're $1 in, and we gained $1. We don't really make. We make about 50 cents, really. Yeah, we'd make about 50. Sorry, we'd make $1. No, we would make. No, we wouldn't make any money at all, really, because we're $1 in. So our premium is $1, and we're bringing in $1. Does everybody see that? So we're not going to make any money. If it doesn't move, we don't make any money. It has to go up for us to make money, but we can only lose $1. Everybody see that? So we can make. If it goes up to 47.50, we make $1, right? And if it goes down, we can only lose $1. So you're basically getting $1 for $1. Everybody see that? You're risking $1 to make $1. Okay? Not preferred, but let's look at that and see what happens. So we transmitted that trade again. Okay? The other thing we could do with this Coca-Cola is instead of doing a covered call or a spread trade, we could do something else. So what we could do is we could sell, if we think it's going up, we could sell the put, right? If we think it's going up, we could sell the put. Okay, we could sell the put. Okay, so if we're selling the put closest to 40. Okay, you can use closest to 40 again. That's fine. Okay, so we sell this one. Okay, but we have to. Let me get rid of that for a second. So we go back to strategy because I want to strategy builder. Okay, because it's going to have multiple eggs. So we sell the 40, and we buy. We have to buy now. We have to buy to cover. Everybody see that? So we sold this put. And now we're going to buy a less expensive put to cover. Okay, everybody see that? Because if we just sell the put and this goes down, it keeps going down, we'll lose dollar for dollar, right? As it goes down. We'll bring in $1.33, but if it goes down 10 bucks, we're going to lose $8.50, right? Everybody see that? Because we're selling the put. So if we sell the put, we're giving someone the right for them to get the stock at a higher price. Sorry, to sell the stock at a higher price and buy it back at a lower price. So they'll make money. So we can sell the put, and let's look at the options, and let's say we sell $5 out. So we sell $5 out, 46, we sell 41, we buy the 41 for 31 cents, okay? So what has happened here is we bought the 130, we bought the 46, we sold the 46, my apologies. We sold the 46 for 133, and we bought to cover the 41s for 31 cents. So the net credit to us, someone's going to pay us, the net credit's going to be 32 cents, right? Net credit is, $1, my apologies, $1.02, 32 cents. $1.02, which is 133 minus 31. Someone's going to pay us $1.02 to do this trade. Now, what are we risking here? What can we lose here if we put this trade in? See, there's a credit of $1.10. Someone's going to give us $1.10. $1.10. Our account's going to go up by $1.10. Okay, that's the credit. But what are we risking here, folks? If it goes up, that's good for us, right? Because we believe it is going to go up, or we wouldn't put that trade on. So let me simplify it for you. Let me simplify it. Okay, forget about this trade because this I think is going to confuse you a bit. Okay, forget about this. If we do just this, if we sell a put, the 46 put, we sell the 46 put. Okay, this is exactly the same thing as a covered call. Everybody see that? If we sell this put, it's exactly like a covered call. Does everyone understand that? Instead of me buying the stock and selling an option, a call, I could just sell the put. It's exactly the same thing. Put equals covered call, yeah. Yeah. But there's something different about this trade, right? What's different about this trade? The premium's better. Yeah, the premium's better, right? Right? The premium's better. Okay? But there's something else that's different. What's different? If I sell this just to put, that's naked, right? That means if this stock collapses, I'm on the hook for it. Whereas the other one, I'm on the hook for it too. Why? I'm on the hook because someone can force me to sell them the stock at a higher price, 46. Say it goes down to 41, they can sell this. They can make me, right? They can make me what? They can make me sell to them for 46, right? To give it to them at 46, and they can buy it back at 41. They might automatically make, $5 minus the $1.33. Everybody see that? Okay, so you know what? I'm not gonna continue with this one. We'll work on this next week or the week after. I wanna just make sure we get some trades in, okay? Because I think I'm confusing some of you, okay? So we have Coca-Cola in. We tried it as a spread trade. And we tried it as a cover call. Basically the same thing. What I'm gonna do though for this one is I'm gonna sell the put. Okay, sell the put at the 40 delta. We're selling. Okay, closest to 40. This one, I'm just gonna sell it as a single trade. Okay, so we're gonna do this trade, and we're just gonna do it by itself. Okay. Okay. Everybody see that? We're just gonna do it. I want you to see the difference. This is basically uh, do not use. Okay. All right. Okay. So we have the 3 trades on Coca-Cola. Okay. What's the next stock we want to try? We'll do this with all 3. What's the next stock we want to try? So we tried Coca-Cola. What's the next stock we want to try? Sam, in the case that you buy the call at 45 and cover it at 47 with the same date, will the covered each other? Will they cover? Yeah, they cover each other. You're covered, right? You're risking $1 to make $1 is what you're doing, Henry. You're risking $1 to make $1, right? You're risking because it's gonna cost. It's gonna cost you $1, right, to do that trade. And if the stock doesn't go up, it's gonna cost. Like if it stays exactly where it is, you don't lose anything. It's pretty much break even. You need the stock to go up though in that trade. So why don't we leave that trade and we'll see how it turns out, okay? We'll just monitor it. We'll just monitor all through, these trades. what I was doing was buying a call and then wait till a week or so and see if the price goes up and then sell it. That's called legging in, Henry, and it can be good or bad, right? It's a little more risky, right? Because you're not covering it immediately. Because if it goes against you, you don't get that premium, right? That because if you buy it and you don't sell the call, you're not getting the depreciation of that call, right? It's not because you sold it, you're not making any money. You would be making money where if it was going against you, right? Where if it's going your way, that's great, but if it's going against you, you don't get that premium. Does that make sense, Henry? Okay. All right. So that was Rodrigo. Rodrigo, do you have any questions, or anybody actually have any questions? Uh, are they required to be exercised in that case? Do you mean in the case that if the stock goes above what you sold? Is that what you mean, Henry? So if you bought a call, yeah, absolutely, it gets exercised. Yeah, it does. It gets exercised. Okay, so we did Coca-Cola. Rodrigo, Vincent, do you have any questions? Vincent, you there? Rodrigo? Not at the moment. Good. Okay, Rodrigo, you're good. And Vincent, are you good? Lost. Okay, no worries. No worries. You're on your phone, right, Vincent? Would you recommend to do options on blue chip companies like Amazon and Microsoft? I would recommend doing it on trades that fit the criteria, really, Henry. If you're looking for a stock that doesn't move much, you got to remember that the blue chips. If you're looking for a blue chip that doesn't move much, Amazon's not in that case, and I mean it moves quite a bit. Um, I just use the criteria that we have. You want sideways to up. You want 2% on the trade, and as a return per month. Just stick to the rules. Stick to the rules. If the stock fits the criteria, it fits. The other one I would tell you is don't do it through earnings, right? Just don't trade. The other rule you'd want to do with covered calls is you don't really want to trade through earnings because you don't know how the earnings are going to turn out. So just stick to the rules. Yeah, I would tell you to stick to the rules. So Vincent, I'm sorry that you're feeling a little bit lost. Let's do this, Vincent. Give me a stock you want to trade. Let's put the trades in and let's reevaluate it next week. Okay, so let's just see how it turns out. Okay, so Vincent, give me a trade that you want to do. Give me a stock you want to trade. And you too, Henry. We did that one for Rodrigo. Give me one you want to do. Oh, when do you do option trading? Are we still applying a 2% ROI rule? Because when you don't buy the stock, then the game might be different. Then absolutely your return is going to be way higher when you just do straight options. Way higher. You know? Well, think about the trade that we just did. If we buy the stock, if we buy the option and sell the option, that return is going to be 100% return. It costs us $1, and we're going to make $1 if it works out, right? That's 100% return. So does that lose? You can lose. You can lose $1. You're risking $1 to make $1, right? It costs you $1. If the stock stays where it's at, you make nothing. If the stock goes to 47, you make $1. If the stock goes down below, your strike price of, what do we do, 46.50, you take $1 loss. Does that make sense, Henry? Not sure how you buy the put will cover you. Don't you have the right to own the stock? You don't have the right to own the stock. What do you, not sure how you buy the put will cover you. You don't have the right to own the stock. Vincent, are you talking about the third trade or the one we just did? Is that what you mean? Okay, so here I'd have to go to the whiteboard to explain how it's just the same. Okay, it's the same thing as a covered call. I didn't want to. Let's try. Okay. So let's do it with a whiteboard. Okay, so you can see this. Oops. I'll show you how it's the same. Okay. Okay. So if you have Coca-Cola is a stock, and it's trading at 46.52, but we're going to say 46.50, okay? Just for the simplicity of the math, okay? All right. If we buy the stock, so we're going to buy, right? Oops. I'm just going to put B for buy, okay? Buy 100 shares, okay? 100 shares at 46.50, okay? And we sell the call at 47.50, right? That was the strike. And we bring in $1.03, okay? That's what we bring in, $1.03, okay? Everybody with me? Okay? So if the stock stays exactly at 46.50, okay? What happens? We make $1.03. Everybody see that? We make $1.03 plus $1.03. Okay, if the stock stays exactly where it's at. Now, if the stock goes up to 47.50, we make $1.03 from the premium, right? Plus, we make $1, around $1 from the stock going from 46.50 to 47.50, right? So we make $2.03. Everybody see that? Okay. Now, if the stock goes down, so that's sideways, that's up. What if it goes down? What price? Give me a price you want to check. Why don't we go to 45? 40. Let's go to 40. Okay, let's go worst case scenario, say 40. And remember, trade management, we don't have to wait till it goes to 40. We can get out of the trade earlier. Okay? So let's say it goes to 40. If it goes to 40, I lose $6.50 on the stock, right? But I bring in $1.03. Okay? $1.03. So if I bring in $1.03 and I lose $6.50, what's my loss? $5.47. That's my loss. Everybody see that? Okay, everybody clear on that? Just double checking. Okay. Now let's run the same scenario with the put, okay, Vincent? Same scenario with the put, okay? So I sell the 46 put, okay? P for put, okay? I sell the 46 put and I bring in $1.33. Let's run through the same scenario, okay? Stock KKO is trading at 46.50. Okay, 46.50. If it stays at 46.50, what happens? What do I make? $1.33. Yep, from the premium, right? So plus $1.33. Everybody see that? If it stays exactly at 46.50, the option is worthless, right? So I bring in $1.33. Everybody with me? Good. Rodrigo, you good? Rodrigo, you good? Good. If the stock goes up to 47, just like the previous scenario, right? The previous scenario, we said, well, if it goes up to 47.50, I make 103 plus $1, I make 203, right? Okay. So if it goes up to 47.50, it goes up, what do I make? I still only make $1.33, right? Everybody see that? I still only make $1.33 because I sold the option. I didn't buy the stock or anything. I just sold the option. Okay? Everybody see that? Vincent, you see that? I want the stock to go up, but I'm only going to bring in the $1.33. Everybody see that? Vincent, you good? Is that clear to you, Vincent? Okay, I'm going to give you a second to respond. I'm going to keep going, okay? If the stock goes down, would there be a time people want the stock from you? Well, you remember, when would they want the stock, Rodrigo? When would they want the stock? If I sell you a put at 46, when would you want the stock? At what price? What price would you put the stock to me? Because that's what a put is. At what point would they exercise that option or be forced to exercise that option? What has to happen? You remember, Vincent, when you have this, when you sell a put, it gives them the right to put the stock to you. It has to go down, yeah. They would be forced to, and Henry's looking at, the 45.27. Do you mean why 45.27, Henry? It's not 45.27. You're off by a little bit. That's not break even. What's break even? So here, I'm going to go over here. So if it's 133 you brought in, okay, and you sold the 46, what's break even? Do you remember, everybody, when you sell a put, it means they can put the stock to you at $46. They can make you buy it at 46. So obviously, if they can make you buy it at 46, they want to get it for less, right? They want to get the stock for less and make you buy it from them at $46. So if the stock goes down to, say, 40, they can buy it from 40 at the open market. They force you to buy it at 46. That's what a put option is. The break-even number would be the strike minus the 133. You see that, Henry? You see that, Henry? So it's because they're only going to exercise, or they're forced to exercise at $46. They're forced to exercise at $46. Okay? So if it goes below $46, their break-even point is, and our break-even point is 44.67. You see that? The stock can go to 44.67 and we are break-even. Okay? Okay? 67.44. What's that? 44.67. Yep, that's what you meant to do. Okay, 44.67. Okay, good. All right. So that's break even. Okay. So everybody understand, right? When we sell a put, right? We sell a put. they have the right to make us buy the stock, put it to us at $46. So they want the stock to go down. Okay, they bought the put because they think the stock's going down. We sold it to them because we think it's going up. Right? Does that make sense to you, Vincent? Good. So let's go back. Same scenario, right? If the stock goes down to 40, just like we did last time, our strike price needs to be lower than the stock price. Yeah, it would be, Rodrigo, because we're selling them the 40 delta, right? The 40 delta. Remember, the 40 delta is what you're selling, right? Does that make sense, Rodrigo? The 40 delta, remember? Okay, good. All right. So if it goes down to 40, right? So the stock goes down from 46 to 40. Well, what does that mean to us if we sold the put? Well, the stock went from 46 to 40, so we would lose $6, right? $6 because they can make us buy it for 46 and they can buy it for 40, but we bring in how much? $1.33, which puts us at what? $4.67. Everybody see that? That's what we would lose. Okay, everybody see that? Vincent, you see that? Rodrigo? Okay, good. Now look, this is a different way of doing a covered call. When we did the other covered call where we bought the stock and sold the put, how much did we lose at the worst case? Well, the same price. How much did we lose? $67 per share. We lost how much? $133. That's right. That's when we sold the put. But when we did the regular covered call, where we bought the stock and sold the put, we bought the stock and sold the call. If it goes nowhere, we make $1.03. If it goes up, we make $2.03, and if it goes down, we lose $5.47. Everybody see that? If I sell the put and the same exact thing happens, if nothing happens, I make $1.33, 30 cents more. But if the stock goes up, I only make $1.33. Remember, the other one, we made $2.03 if it went up. So in this case, when you sell the put, you don't make anything if it goes up. You just get the premium. And in worst case scenario, when the stock goes down, I lose less because I brought in more premium. Does that make sense? Does that make sense to you now, Vincent? Why it's exactly the same? It's exactly the same. Okay, good. Good. That was good. I'm glad you guys, good. That's excellent. Good. So you see why selling a put is just like a covered call. Right now, we're just going to let these trades run. But at some point, we're going to learn about trade management. When is it a good time to close the trade early? We want to know. When things are good, when should we close it? When things are bad, when should we close it? It doesn't have to go to the end of the month every time. Does that make sense to everybody? We're not going to wait every time till the end of the month. There's a time for us to take action. Okay? Once the trade's in. All right, we have 10 minutes. Give me another stock to look at, okay? Let's look at another stock. Looking forward for this topic. Yeah, it's going to be great. Okay, let's look at one more stock, okay? Let's put some trades in, okay? So give me another stock to look at. Vincent or Henry? Rodrigo, you got your Coke in. So give me another one. I can only do one more, so who's got one for me? I have Canadian stock BPY.UN.TO. Let's see what comes up here. BPY. Let's see what BPY is. Is that what it is? Brookfield Property Partners? I bet you that's not what it is. Oh, it is? BPY. Is that it? BPY? Yes, it is. Okay, good. Okay, BPY. It's traded on, looks like, NASDAQ. Doesn't look like there's a lot of options for this. Looks like it goes from 2 to 37 days. So we can try this one. It's just not giving us a lot of, options to work with. You see that? Not so many people, I guess. We can try it if you want. Okay. Do you want me to keep going? Would you consider this less option stock? Yeah, there's not a lot of there's no weeklies. It's not like you can't do it, but there's no weeklies. I would want more, more activity is better, more liquid. Okay, NVM, NVM, NVM is, who's that? Oh, I mean, never mind. Oh, all right, okay. Give me another stock. Give me another stock to look at. Home Depot. Okay, sure. Excellent. Home Depot. Uh, Home Depot. Okay, so Home Depot, we're going to go, first we're going to look at the stock. Okay, should be fine. Okay, here's the stock. So this is nice. I like this. This is good. It's at the top of the range, but it's in an uptrend. It's at the higher end of the range. There might be some resistance right here. You can see that. But let's trade it. Let's see where we go. So it's definitely in an upward. It just filled the gap. I don't like that it's at the top of the range, but it's okay. Let's put the trade in and see how it'll go. Okay. Bitcoin, you can do it with ETFs. I'm sure there's a Bitcoin ETF you can do that with, Rodrigo. I'd rather you stay away from that right now. And we'll come to currencies and alternative things like Bitcoin later. Is that okay? Okay, so we're gonna use Home Depot. Okay, so let's say that it's good there. Let's look at we need more of these, so let's look at 30 days. So we go to 30 days. Yeah, Tesla's volatile for sure. Yeah. Okay, so 30 days out, we go to the 40 delta. So let's go to strategy builder. Okay, we're going to buy the stock and we're going to sell the 40 delta, which was closest to 40, which is the 265. So we're going to sell it. There's a big spread here. We'd probably be somewhere in between. Let's just use that for now. The 490. Okay, so let's check what the return on investment is. Okay. So if I get 490 and I buy it for 265, what's the return? So Vincent, is Vincent's trade? Yeah. What are we getting? Who can tell me? We get 490 and we do 265, which is sorry, it's not 265, it's 258.50. 258.50. So we get 490 divided by 258.50. Yeah, it's close to 2%. It's 1.9%, but you know what? I would still accept that as 2%. I would accept it though, Henry, because we're gonna get better than 490. We'll probably get a better price than 490. Okay, because it's in between. We just took the lower end. So let's accept this. Okay, so let's transmit this order. We're going to be 252.86. I'm going to transmit it, okay? We're going to keep this order. Okay. That's just telling us we're going to do it tomorrow. Another thing we're going to try is We're gonna do what we did with the other one. We're gonna buy the 60 closest to 60. We're gonna buy the 252.50, and we're gonna sell the 40. See how that one turns out, which is there. Okay, so we're gonna transmit that one. See how that one works out, and we're also gonna do what? We're gonna try selling the put. So we sell closest to 40, which is this one. So we're gonna sell that option. Okay, and see how that works out. Okay, all right. Everybody good? So we'll leave these three, and we'll see what happens, and we'll monitor it next week. Okay. So those are our trades right there. We'll see what gets triggered. Okay. So we have the 3 Coke trades and the 3 Home Depot trades, and we'll see how these turn out. Okay. We'll see what gets triggered tomorrow. Maybe not all of them get triggered. We'll see, because they're all limit orders, right? If we don't get these prices, it won't trigger it. Do we care to use limit? Yeah, we're using limit. We're using limit. Yeah, we're going to use limit. Yeah, we're going to use limit prices. Okay, so right now, let's see what happens. Let's see what happens. Okay, let's see how these trade. Okay. Okay, any questions before we wrap up? Good, good. I'm interested to see how these trades come out. We'll see what happens next week. If you're good, type in yes or Y. Okay, good. Will you load this one too? Yeah, I'll load this one up. I'll load this one up. Yeah. No worries, no worries. I was gonna say that. We're good. We're good. You'll get a chance to review it. No worries. No worries. No worries, folks. I'll see you all next Wednesday, same time. We'll see how our trades are doing, and we'll talk about maybe some trade management if it's right. Okay, but let's try to understand what happens in these trades. Okay, and see how they work. Okay, good. We'll see which one works the best. All right. So I'm going to thank everybody for coming. I will upload this as soon as possible, and I want you to have a great week. Stay paper trading, okay? Everybody, just paper trading. Unless you're comfortable with trading yourself, I'm not endorsing that at all. I want you to paper trade to understand, to make sure you trade these right. At some point, obviously, when you feel more confident and you've shown yourself that you can do this, definitely the idea is to make money, okay?